Want to make a kid a millionaire, get $20,000 invested in their Roth IRA by the time they turn 20. At $20,000 alone will grow to $1 million by the time they turn 60 without any additional contributions. So max out your Roth IRA, because it's not about how much money you make, it's how you make it. It's these vehicles that can really help you build financial freedom and build a lot of wealth. What's going on, everyone? Welcome back to the Learn Like a CPA show. I'm your host, Ryan Bakey, and today I'm going to be talking about the number one wealth building tool when it comes to retirement accounts. And that's right, it's the Roth IRA. And with the Roth IRA, I think it's the foundational tool that everyone can use to build wealth. So what is it? So a Roth IRA is an individual retirement account. IRA stands for individual retirement account, which basically means that if you want to set it up, you don't have to get permission from anybody. A 401k is an administrative plan with your employer. You have to be employed in order to set up a 401k. An IRA, anybody can set up an IRA account. You just have to have what's called earned income. So as long as you're working a W-2 or you have a job, then you're going to be able to contribute to your IRA. Now, a Roth IRA, what's so powerful about it is you can contribute to it, and it's going to earn and grow tax-free as long as you adhere to the Roth IRA rules. And we're going to talk a little bit about what the rules are. But the reason why this account is so important is because every single dollar that accumulates in that account and the money that you put in there is going to earn and grow tax-free for the rest of your life and for the rest of your heirs' life. We're going to talk a little bit about that later on, about what are called RMD, or required minimum distribution rules. So what is it? It's an individual retirement account that you can open up on a Vanguard, Charles Schwab, Fidelity, whatever platform you like to use. How does it grow? Okay, so the Roth IRA, you put the money in post-tax. So this is money that you've already paid taxes on, and you're going to put that money into the Roth IRA. So for 2024, you actually can put $7,000 in a Roth IRA, and they normally adjust this every single year a little bit for inflation. So last year was $6,500. The year before it was $6,000. I want to say when the Roth IRA first came out, it was actually $2,500 or $3,000 was the minimum. And then they've been raising it for inflation. The Roth IRA is going to grow tax-free as long as you adhere to some of those rules. Now, let's talk about the rules on withdrawal. It is super important to understand that with a Roth IRA account, any money that you withdraw, you have to figure out if it's going to be principal or earnings. The principal is the amount of money that you put into the Roth IRA. The earnings are what it grows, what earns on that earnings. So for example, if I put in $7,000 and 2 years later it grows into $10,000, I can always tap into that $7,000 of principal completely tax and penalty free. This is an important concept because no other retirement account is like this, where you can just go grab some of it without having to pay taxes or penalties. If you try to grab 401k money, guess what? Tax and penalty. If you try to grab most retirement accounts, there's going to be some sort of tax or penalty, not with Roth IRA contributions. So that's why it's really important to know that it can almost serve as like a smash the glass piggy bank for you, because remember, at any point in time, you can always grab those Roth IRA contributions. Now, I will say this. I've had people ask me, I've had people talk to me and say, well, times are tough. I need money. I want to fund my next deal. I have this Roth IRA money sitting around. Should I pull from the Roth IRA? Now, math-wise, you have to think about this. There's a reason that the government only lets you put in a certain amount of money into this account per year. It's because they know how powerful this wealth building tool is. And so you only get a certain amount of years over the course of your life to contribute to the Roth IRA, because it's however many years you're working. And so you really want to maximize every single working year to be able to contribute to your Roth IRA. So that being said, I've run hypothetical scenarios, and I don't want to bore you to death with the math, but I would almost rather run a line of credit at 17, 20, 25% interest than take money out of my Roth IRA, because that money is going to grow tax-free for the rest of my life. Now, talking about some of the withdrawal rules. So if you withdraw the money before you're 59 and a half, and it's not for one of what are called the qualified expenses, then you're going to have to pay a 10% penalty. And likely you also pay income tax on that as well. Now, income tax on the earnings. Now, with the Roth IRA, what makes it so special is some of the exceptions to this rule. So, for example, one of the biggest exceptions that a lot of people don't know is that you can withdraw up to $10,000 of Roth IRA earnings. Again, not just contribution, but earnings. You can withdraw up to $10,000 of Roth IRA earnings completely tax and penalty free if it's your first time home. Okay, so think about if you have a kid, or maybe you're in your early 20s, you contribute $7,000 a year to a Roth IRA. You got $25,000 contributed over 5 years, and then that is going to grow and earn $10,000 on top of it. You can withdraw that whole thing if it's for your first time home. So maybe that's an exception that I'll make to the rule about never withdrawing from a Roth IRA unless it's your first time home. And imagine comboing that for the real estate investors out there. Imagine comboing that with your first time house hack. Right, so you're contributing to this Roth IRA, you're stashing money, it's earning and growing tax free. The government's not getting their hands on it, and then you use it to go buy your first house hack. It's an amazing strategy. Now, let's talk a little bit about when to contribute to a Roth IRA. I think it always makes sense for people to contribute to a Roth IRA, especially people in their early 20s or 30s even, because those are going to be some of the lowest earning years of your life, typically speaking. And so with a Roth IRA, you're paying taxes when you put the money in, and you're locking in that low tax rate. Why is it low? Well, number one, in your 20s, you're less likely to make as much money as you will in your 30s and 40s. Those are typically your peak earning years when you're in your career. Number two is the government has been printing a lot of money lately, and it is likely that the tax rates will go up in the future. And inflation, tax rates are going to go up. So you're better off contributing those tax-free dollars today, letting them earn and grow tax-free for the rest of your life. Now, a lot of people ask, well, when is the best time to convert to a Roth IRA? Maybe you have a traditional 401k, maybe you have a regular 401k, maybe you have a traditional IRA. When's the best time to convert to a Roth IRA? Number one, anytime you have what I call a shock in income. So if let's say, for example, you are engaged or you're dating somebody and then you get married. Well, what does that do to your tax bracket? You might be in a 22, 24% tax bracket. You might be in a 32% tax bracket. But once you get married, maybe you're in a lower tax bracket. That is a year that I want to do a Roth conversion. Anytime I'm in a lower taxable year than I'm normally going to be in, that's when I want to do a Roth conversion. So let's say I make a lot of money, and maybe my spouse makes good money too, but then we get married. Now we get to filing joint tax brackets as opposed to both filing single. And you would be shocked at how the incentives that the government has for people who file married versus file single. The government wants to incentivize homesteading and people being married and things like that. So they allow you to pay less in taxes if you're married, basically. Now, I said a shock in income year. Well, what's another year where you might want to do a Roth IRA conversion? Well, that could be in a year where maybe the stock market's down. So, for example, let's say I contributed $10,000 to a traditional 401k or traditional IRA. I got my tax deductions, and a couple of years go by, and maybe that $10,000 that I put in is not worth $10,000 anymore. Maybe it's only worth $8,000. I still own the same amount of shares of stock, but if I convert to a Roth IRA, I'm only having to pay taxes on 8 as opposed to 10, even though I have the same amount of stock. So you want to look to in years where the stock market is on a downturn, you want to look to convert to a Roth IRA that year, because that would be advantageous because you got a tax deduction for 32, 35%. And then when your tax bracket's 22 or 24%, you do the conversion, and that's how you take advantage of the game, basically. The other time you would want to look at doing a Roth IRA conversion, this kind of goes into point number one, is if you're a real estate investor and you are qualifying for real estate professional status, or maybe you're using the short-term rental loophole. So those are some of the things we talk about with our 365 tax strategy clients, and you convert from 401k to Roth IRA. Well, you can use the losses from your rental properties to offset the 401k to Roth IRA conversion and ultimately pay nothing in taxes on the conversion because you have losses coming from real estate. So let me show you how that works, right? So typically what happens when we work on this with clients is the client's going to go buy a rental property. Let's say the property is worth $500,000 and we do tax planning projections to say, we think that you're going to get $100,000 loss from this property. Okay. Well, then the client can go and withdraw or convert $100,000 from their 401k to a Roth IRA. So they have that $100,000 that hits their income bucket, but they also have a $100,000 loss if they qualify for the certain exceptions. And if they are following, good tax planning advice from a CPA or an enrolled agent, they can offset the $100,000 Roth IRA conversion with the $100,000 real estate loss. And it's one of the perfect tax planning opportunities. Just some quick math for you. So I was doing some numbers the other day, and from age 25 to age 65, if you just put $150 a month into it's $150 a month that you need to contribute from 25 to 65 to become a millionaire. Okay, $150 a month times 12. I mean, we're talking about like less than $2,000, $2,500 that you need to invest in order to become a millionaire if you just invest from 25 to 65, right? But you want to start. Imagine if you're investing $7,000 a year, which is 3x that amount, okay? From 25 to 65, you will have $3 million in a retirement account that's all comes out tax-free because it's in a Roth IRA. So max out your Roth IRA if you can feasibly possible, because the math shows that it is one of the best wealth building tools out there for us. Another part of the Roth IRA is understanding time value of money, which is another podcast that I'm going to do pretty soon here. But understanding time value of money says the sooner we can get those dollars invested into this account, the better off we are, right? So how can we get money into this account as soon as possible? Well, typically, most people, they have to earn the money first and they have to work a full-time job. But if we're parents and we're employing our kids in our businesses or our real estate, well, we should be putting them on payroll. Why? Because now that they have earned income, they can contribute to a Roth IRA. And so write this down. This is a note taker. $20,000 at age 20. If you can get $20,000 invested in a Roth IRA for your kid by the time they turn 20, that $20,000 alone will grow to $1 million by the time they turn 60 without any additional contributions. So if you want to make a kid a millionaire, get $20,000 invested in their Roth IRA by the time they turn 20 and throw away the password. Don't let them have access to it until they're 60. And congrats, you just made your kid a millionaire and they probably didn't even know it. $20,000 at age 20. Pro tip number 9, we're kind of going through the tips here. How can it play into your financial freedom? And this is one of the most sort of putting the puzzle pieces together for real estate investors, because remember, your Roth IRA can always be accessed, those contributions, tax and penalty free. So if you ever need the Roth IRA contributions, you know that you can always access those. So if I'm a real estate investor and I'm looking for financial freedom, how does that tie into my overall situation? Well, when you're targeting financial freedom, then the biggest things you want to focus on is a tax efficient retirement and a tax free retirement. And what do I mean by that? A tax efficient retirement is owning a bunch of rental properties. Why? Because if I own a bunch of real estate, odds are I'm not going to be paying a lot of taxes because I own a lot of real estate. Now, I'm going to be paying some taxes, so that's why I say tax efficient. A tax-free retirement is I have all this income coming in and I'm not paying any taxes on it at all. And that's what a Roth IRA will do for you if you follow the rules. The Roth IRA is going to offer a tax-free retirement for you, and real estate for the most part is going to be somewhat tax-free, mostly tax efficient. But stacking those different income buckets on top of each other, you have the Roth IRA money, you got real estate money, it lowers your tax bracket. Because think of this, in retirement age, if you're let's say you have a $200,000 a year pension or $150,000 a year pension, whatever it is, that's all ordinary income. It stacks up on top of your tax bracket. But if you had $150,000, $200,000 coming combination from your Roth IRA because you got $3 million in your Roth IRA because you heard me talk about it on this podcast when you were 25 and you started investing in it, and you also got real estate money coming in, you could have $150,000, $200,000 a year retirement income stream and pay nothing in taxes, because it's not about how much money you make, it's how you make it. It's these vehicles that can really help you build financial freedom and build a lot of wealth. Another tip that we touched on a little bit earlier is that one of the pro things about a Roth IRA is that there's no required minimum distributions. So for example, if you have an IRA or a 401k, the government requires you to start withdrawing on that while you're around, typically around your early 70s. And the reason they do that is because they don't want you to pass away with it, and then they have to go hunt down your kids to then tax them, which does happen. If you die with an IRA or 401k, it becomes an inherited IRA, and the government actually tracks down your heirs and they tax them. With a Roth IRA, there's no required minimum distributions with a Roth IRA. So you don't have to sell part of that while you're still alive. And in fact, the Roth IRA goes to your kids tax-free, penalty-free. It's the only retirement account that works like that and operates like that. There's no required minimum distributions. The last thing I would talk about the Roth IRA is understanding the contribution rules. If you are a high income earner, and I don't know the number off the top of my head because it's adjusted for inflation every single year, but pretty much if you're a six-figure earner, you have to follow the Roth IRA rules when it comes to who can contribute. Because if you make too much money at your job, you're likely not able to contribute to a Roth IRA directly. You have to do what's called a backdoor Roth IRA. And it's a very simple process. You can look it up online. You can talk to an advisor, but you contribute to a traditional non-deductible IRA, and then you wait 4 or 5 days later and you convert it to a what's called a Roth IRA. We call it a backdoor Roth IRA. So this is a tip. If you're a high income earner, you can't contribute directly to a Roth IRA, but you can do what's called a backdoor Roth IRA and get the money that way instead. Thanks for tuning in to the show today, guys. If you want more advice or questions, feel free to connect on the Facebook group, Tax Strategies for Real Estate Investors. We got over 10,000 real estate investors in the group engaging daily. And I'll see you guys on the next episode.